Good day, students. Welcome back to the class, and we are talking about derivatives. A very new subject, a very exciting subject, and a very interesting future talk about products that are now coming up very much into this region as well as the must trade, must learn, must educated topics. So derivatives is what we've been talking about, and this is important for us to understand that futures and options are products of the derivatives, and these give you large variations. So you could be talking about options trading on maybe metals, indices, futures, and you could be talking about future contracts on maybe heating oil, gold, foreign currency, UST bills, a number of other issues like the stock market indices, which would mean that you've been given a large variety, a large horizon to work on your financial products, and a large way on the canvas that you can look at your investment portfolios being now diversified in a much bigger way. These product characteristics have been explained to you in the previous lecture. My main aim now is to keep on revising these topics because this subject is fairly new to most of these students. We have understood by now that derivatives is based on an underlying asset. And the underlying asset is that which you have the right to buy or sell with options, and with the option to buy and deliver as in futures. We have listed derivatives and the over-the-counter derivatives, with listed derivatives being much safer than the over-the-counter derivative with a little bit of risk. The exchange-traded derivatives are handled by the Chicago Board of Options Exchange and the Chicago Board of Trade. However, the OTC derivatives are handled individually or through two institutions, have a little bit of risk involved in it as far as the deliverables are concerned and the responsibilities are concerned. It's always a good idea to be trading on the exchange. Options are obviously securities and are regulated by the Securities and Exchange Commission, the apex watchdog for all these transactions. And we have the Commodity Futures Trading Commission, which handles the futures contracts as well. Now, the futures contracts are handled by CFTC, whereas the option contracts are held by the SECP. So, we would understand that these two are the bodies responsible for looking after tradings in options and tradings in futures. Having talked about the product characteristics, having talked to you about a little bit about the difference between options and futures, it would be a good idea to remind you of other things related to the derivatives products and where are they really traded. They are actually traded on the exchange. So the futures exchange is a place where you can trade future contracts. These are non-profitable organizations like our own stock exchanges, which are dwelling upon the incomes from commission generated through the fees that are charged on the brokers. These are organized marketplaces where there are established rules that are governing the trade. And like I mentioned, these are funded by the dues and fees that are charged for services rendered thereby. Members may trade for themselves. Members trade for others as well. But I think it would be a good idea to look at members that do not trade themselves. It's not a good idea for members to be trading on themselves because it just exposes them to more risk factors. It's a good idea just to focus on trading on behalf of investors. So what then was a futures contract? Was an obligation to buy or sell a fixed amount of an asset on a specified future date at a price determined today. So that would mean a commitment made between a buyer and seller, and then you offset the position by creating an opposing trade to the original trade, to settle the trade, to finish the contract. The Commodity Futures Trading Commission regulates the trading in the futures, so you can complete the futures trade on the day of maturity or prior to the day of maturity, as is when the suitability is to the original position holder. So you would be a buyer of a product or a seller of a product. Either way, you can settle on date of maturity or prior to it. There are a wide range of products available. These are all exchange traded. Then you would be understanding there are certain rules to be followed, certain specifications to be looked at, which would mean you must have an underlying asset like crude oil or maybe short-term interest rate or amounts and units of the underlying asset as described in the contract. You would also look at the delivery month. You will also look at the last trading date. I mentioned Friday is the last trading date here locally of the month where you can trade. You need to talk about the grades, the quality. You need to talk about the type of settlement. Maybe it's a cash settlement or a physical settlement. The currency in which you have to settle the futures contract could be local, could be a foreign currency. These are settled daily. Mark to market is the actual word. These are settled daily to find out what the profits have been or what the losses have been. We have different kinds of markets. We have a regular market, which is a spot or cash market, in which price refers to items available for immediate delivery. We have a forwards market, in which price refers to items available for delayed delivery. And of course, we have the futures markets, which we are talking about right now, sets features, contract size, the price, delivery date, conditions for delivery. So you have these three different markets working for you in the financial sector. It is for you to choose what sort of a market would you want to get into. Futures market is a good market because you can do work on the futures market through a margin. And you need not have the entire cash with you to be dealing on the futures market. Another characteristic we must understand while we are understanding futures markets is that futures markets are centralized marketplaces which allow investors to trade with each other, and the performance is guaranteed by a clearinghouse. We talked about the clearinghouse. The deliverables and the cash delivery is guaranteed. That is why we always call exchange traded trading a much better form of trading. There are valuable economic functions in which hedgers use it to shift price risk to speculators. We haven't talked a great deal about hedgers, speculators, and arbitrageurs, but we'll do that in a while. There is a price discovery that conveys information in the market. We use the futures market in a variety of ways. Like a word mentioned just a little bit earlier, the words that I mentioned was hedgers, speculators, and arbitrageurs. But that's for later. Right now, we must talk about commodities and financials and foreign future markets. So commodities can be used to be traded like agriculture, like metals, and other energy-related products. And we can use foreign currencies to trade in, and we can use that as debt instruments and equity instruments. Increasingly, because of globalization, there is a marked interest in foreign future markets as well. And these markets are quite competitive with the US market, although US markets are the market leaders and US markets are the benchmark, but we are finding increased global competition to be seen in comparison with the US market. So you have other markets globally as well, besides the American market. I just mentioned the word clearinghouse guaranteeing the end result of a trade. So a clearinghouse is a corporation. We too have clearinghouses here locally. A corporation which is separate from the exchange but works in association. Stock exchanges work with the clearinghouse and vice versa. They cannot now work separately. They work in association, and exchange members have to be members of a clearinghouse as well to complete the transaction. So you have to be a member of the stock exchange or a commodity exchange and member of the clearinghouse as well. The clearinghouse helps facilitate an orderly market. It also keeps track of all the obligations that have to be fulfilled. A clearinghouse helps facilitate members this way. What do you do then to go about in the trading of the futures market? You could go to the market and go through the open outcry method, where you have sellers and buyers agreeing to take a particular decision, a particular contract at a decided upon price at a future date. Or you could go through electronic trading. So a seller or the short position holder would commit to deliver an item. On the other hand, a long position holder or a buyer would commit a trader to purchase the product and give out the cash in return. So you have buyers and sellers, or longer position holders and short position holders in the futures market. And like options, future trading once again is a zero-sum game. Now, the contracts can be settled in more than one way. Two ways to be precise. One, through a delivery. Two, by offsetting, with offsetting being accountable for 98% of the trades and deliverables being just 2%, which means more transactions are actually cash settled, offset before maturity time or on maturity time, than actually going through the process of deliverables. Each exchange establishes price fluctuation limit on contracts, certain benchmark beyond which prices cannot go up or down. Remember, once again, there's no restriction on short selling in the futures market. We have restrictions of short selling in the regular market, but not so in the futures market. So you can have both sorts of transactions in the futures markets. We just mentioned the word cash settled or deliverables, which means in the context of delivery that if a future contract is not closed out before maturity, it is usually settled by delivering the assets underlying the contract. There has to be an asset underlying the futures product. When there are alternatives about what is delivered, where it is delivered, and when it is delivered, the party with the short position chooses all these things. So either you cash settle your futures contract, or you go through the process of delivery in the futures market. Cash settle being more in vogue than deliverables. Like I mentioned, just 2% in deliverables, 98% cash settling or offsetting. To do all this, to trade in the futures market, we need some sort of a thing called a margin. What really is a margin, and we talked about this before, talk about it again now, is a cash or marketable security deposited by an investor with his or her broker. The balance in the margin account is adjusted to reflect daily settlement. Margins help. Margins minimize the possibility of a loss through a default on a contract. Margin is something that brokers feel comfortable with when they're taking in orders to buy or sell from investors. It gives them a comfort level that they'll probably be obliged to pay up when and if time does arise. So margins are required by the brokers, both from buyers and sellers. Margin is an earnest money deposit made by both buyers and sellers to ensure performance of obligations that will be met. Don't mix it up with an amount being borrowed from a broker. It is an amount not borrowed from a broker, has to come up from yourself, will be matched in bigger way by the broker. Each clearinghouse sets requirements for margins, and brokerage houses can require higher margins depending on the credibility of an investor. Initial margins usually range from as little as 5 to 10%, may go as high as 50%. But generally speaking, we have noticed that normally people are comfortable with 10% to 30% of the margin, with 30% being a more likable figure for the brokers, which would mean then 70% of the margin then we put up by the broker or will be taken care of. We've also talked a little bit about what is a margin call. They are calls that you get when prices go against the investor's position. Any time that there is a dip in your margin, you'll be getting a margin call from the broker. That's probably the only time that a broker will probably call you is when you're short of cash. So then you must deposit more cash or close the account or close the trade. Either way, you have to keep the facility available for the broker to feel comfortable with your position. The positions, remember, have been marked on a daily basis. Profits and losses can be understood, have to be taken care of daily. Profits may also be withdrawn if there are any, but losses have to be come up with more cash to be deposited into the broker's account. I had mentioned to you about hedgers and speculators and arbitrageurs. Now is about the right time for me to talk to you more about hedging, speculation, and arbitrage. Now, these are words describing people and how they use the derivatives markets. The derivatives markets are used to hedge risk. They are used to speculate. Investors take a view on the future of the market direction, and then they also use it to lock in an arbitrage profit. So you can speculate, you can arbitrage, or you can hedge. It changes the nature of a liability, change the nature of an investment without incurring the cost of selling one portfolio or buying another one. Derivatives help us in this way. One of the better ways to look at the derivatives market or to use the derivatives market would probably be through hedging, but definitely not through speculating. But then you have all sorts of investors in the market, and they may do as they feel comfortable with. So you'll come across hedgers, you'll also come across arbitrageurs, and of course, speculators will actually be the driving force for the market. Needs a lot of gut to be a speculator because you're vulnerable to the worst possible risks involved in future markets trading. So if I were to be involved in the futures market, I'd rather arbitrage or I'd rather hedge than speculate. And that is probably why derivatives are called dynamite or dreaded to be investing into. But you can trade in whatever ways you can. I think hedging is good. So what then would be a hedger? A hedger would be a person who uses the futures market, the derivatives market, to reduce risk that they may face in the future. You hedge your risk. You try to minimize the probability of a loss. You try to maximize your profits. So hedging is just doing that by shifting your liabilities, by shifting your risk to a speculator. In hedging, you're actually safeguarding your losses or minimizing losses. And we talked about hedging in another way when we talked about the stock markets by putting a stop loss order while you're going long in the stock market. This is a little bit different, but you sort of offset your trade through an underlying asset. So how to use hedging then? If someone bears an economic risk, if someone is using the futures market to bear an economic risk, to reduce risk, the person then would be called a hedger. So he's using the futures market to bear an economic risk and then to reduce it. Hedging is prudent. Hedging is a prudent business practice, and a prudent manager has a legal duty to understand and use the futures market hedging mechanism. Portfolio managers, asset managers, individual investors, individual responsible for somebody's portfolio, pension funds, other assets, and people who are managing these assets and portfolios have been found out to be very prudent when they use hedging as a means of minimizing risk or reducing risk, and that way also increasing levels of profits. So hedging is a good idea when you shift the risk of price to another participant, probably once again a speculator. So hedging is one of the ways that we ideally can take advantage of the futures market. Hedge would put a division or barrier between a profit and a loss. The way you use a hedge is that you have a covered position in which you can have an underlying asset which can be used in the futures market. You mix up the regular market and the futures market in hedging. So at risk, when hedgers are at a risk with a spot market asset and are exposed to unexpected price changes because we really don't know what there is in the future. If you bought something in a regular market, you don't really know if you're going to be getting the right type of values for your investments. So you buy or sell futures to offset that particular risk. You shift your risk from one market to another market. You shift your risk from one participant to another kind of participant. So you mix up both regular markets and futures market to offset risk. So then you may call using hedge as an insurance. It is a form of insurance, and hedgers are willing to forego some profit to reduce risk. You may not get as much profit as you might in speculation, but you definitely get some profit, but of course will be reducing risk as well. So hedged return has smaller chances of low return, but also smaller chances of safety or high return as well. But you're safe. When you hedge, you are safe. When you're hedging, you're minimizing or completely eliminating risk. When you're hedging, you're offsetting your responsibility. You're offsetting the factors included in risk. It's a good idea to hedge. It's a good idea to use hedging from one market to another. So if you've sold something, you can always cover it back, but it's a good idea to use your collaterals or your covered future positions with an underlying asset that you already own. You can short hedge, you can sell. Cash market inventory exposed to a fall in value, you can short sell. You can sell futures to profit if the value of the inventory fall, or you can go long. So it will be called a long hedge. You buy in anticipation, you anticipated purchase exposed to a rise in cost. Or you buy futures now to profit if costs increase. So you can sell short in anticipation of a fall, or you could go long in anticipation of a rise in the cash market or in the futures market. You sell. And that is how hedging works. You short sell or you go long in both positions in the cash market. You short yourself in the cash market, in the regular market, and you may sell in futures now for profits if the volume is expected to fall. You can use both different markets in hedging. The best way to use a hedge would be then to have bought something in the regular market or spot market or the cash market and sell it at a future date. And keep in mind, there is always a difference between a future price and the price in the regular market. So there will be a spread which will make the profit or the difference for the time period, because regular is now, future is maybe a month later. You're also going to be charging for the difference in time period as well. If we were to look at an example of hedging in which a US company will pay 10 million pounds sterling for imports from Britain in 3 months and decides to hedge using a long position in a forward contract. The importer is in US. Material that has to be coming from Britain, 10 million pounds, you have to pay up, so you hedge using a long position. You obviously have to pay them, so why not pay them in a good time by taking a long position in the future? You book the value now because then you're sure this is what you'll be paying 3 months later. Another example would be an investor owning 1,000 shares of Microsoft worth $28 per share and a 2-month put with a strike price of $27.50 costing $1. And then the investor decides to hedge by buying 10 contracts. Remember, one contract is equal to 100 shares. So if you're talking about 1,000 shares, divided by 100 shares will become 10 contracts. So you buy 1,000 shares in the regular market, you talk about 10 contracts in the futures market. So you could use these two examples to illustrate the meaning of hedging, in which you communicate yourself and commit yourself to a position whereby you'll be sure what lies in the future. 3-month delayed payment, but the price settled now. Now this slide will actually tell you about the value of the Microsoft shares with and without value, which means if you look at the dotted line, that is without hedging. There's no hedging in the value, and the solid line will tell you that there is hedging, which means, do you notice the dotted line is going all the way from 20 upwards, which means the price can fluctuate both ways. On the other hand, in a hedged transaction, price shall not go below a certain price, which could be something like $27.50. So in hedging, there is a loss limit, whereas if you're not hedged, the loss can be as much as the entire value of the product. It's always a good idea to hedge and go ahead with the trade. That was about hedging. How about talking a little bit about speculation then? So who then would speculate? A speculator would be speculating, and a speculator would be a person who uses derivatives to bet on the future direction of the market. Interesting. It's about betting. It's about speculating. It's about trying to predict the future. You could be right, could be wrong. If you're right, you make money. If you're wrong, you lose money. That's what speculation is about. You speculate on the outcome of the result. You could be right, you could be wrong, you can't be sure. You're not sure about profits in speculating. If you are a speculator, if you're talking about speculation, talking about enormous amounts of risk. And if you're talking about enormous amounts of risk, we're also talking about enormous amounts of profits. The speculator would be somebody, a person or a firm that accepts the risk the hedger does not want to take. Hedger will not take this risk, but speculator will take this risk. So speculators believe the potential return outweighs the risk. Speculators believe, these speculators will then consider that the risk is worth taking because they'll make more money in speculation than through hedging. The primary purpose of derivatives market is not speculation. Please keep this in mind. Speculation is not the right mode of trading in the derivatives market. It is one of the ways of trading, but not the best way. Rather, speculation permits the transfer of risk between market participants as they desire, because there will be other speculators as well. You're not going to be the only speculator in the market. There will be others of your kind in the market. There will be others of the hedgers' kind in the market. There will be others of the arbitragers' kind in the market. All types will make up a market, like all types make up a society. So you'll have speculators who will find other speculators who are willing to share their vision in taking risks. Some will speculate on the market going down. Others will speculate on the markets going up. Will be then dependent on how bullish you are about the market or how bearish you are about the market, how positive you are about the market, how negative you are about the market. So you would understand this by understanding what sort of a speculator would perceive the market to be. You're trying to find the future without actually being in line with reality. It's just a wild guess. Let's have a look at an example of speculation. And an investor with $4,000 to invest feels that XYZ company stock prices will increase over the next 2 months. Currently, the price of stock is $40, and the price of 2-month call option with a strike price of 45 is $2. Now, this is speculation in its wildest imaginations, because you already own $4,000 worth of stocks, and you think it'll increase over a period of time, maybe 1 month or 2 months. You may find out, obviously, right now the price is $40. You're even trying to buy more at $45 price. Instead of hedging on this and selling what you own at $40 for a price of $45 2 months later, you're actually asking for more trouble. Instead of booking $45 price, you're actually exposing yourself to more speculation in the future. So, if the price of your stock goes down in the regular market, and obviously the price in the future market also goes down, this is a classic case of double jeopardy. You lose in the regular market, you also lose in the futures market. A hedging would be a better way of handling such a situation, whereby you could hedge the underlying market in the futures market. You already own 1,000 shares, and you're already getting $5 spread on the price. So you could actually hedge, but speculation was the example we needed to give you. Now, remember, there was another player, there was another type of trader that I had mentioned, was the arbitrager. Who then is an arbitrager? An arbitrager is a person who takes two opposite positions on the same instrument in two different markets to earn a profit. You take advantage of the discrepancy or the difference of price of the same product in two different markets. The two different markets could be in one country. The two different markets could be in two different countries. Derivatives are excessively used for all these purposes. Remember, the speculators, there's no small amount of speculators, there's no small amount of hedger or arbitrage. It's all almost in abundance in the derivatives market. So you take advantage of different prices between one exchange and another exchange for the same product. And it helps book profits. You lock in your trade by booking profits by buying in one place, selling in another place. Of course, you have to switch over and offset the positions in both the exchanges, but you do that at the same time looking at the price variations. Most of the time, but not always, you will be making money in this sort of a trade. Generally speaking, you'll make money. Very rarely will you not be able to make money if the market is really behaving erratically or the market is really volatile. Then probably you might have a problem in having profits. So then arbitrage is the existence of a riskless profit. There's no risk, there's only profit. You've locked in the trade, and there are arbitrage opportunities that are quickly exploited and eliminated. It just is there for maybe a little while, few seconds maybe. You have to look at the difference in prices. You have to look at the discrepancies. You also have to look at the situation whereby why did such a discrepancy arise. You've got to take positions depending on the liquidity on the float of the share. You might not just be able to sell as much in one exchange as you have bought in another exchange. Because maybe it's a bigger exchange. We have not just talked about exchange being a bigger exchange and a smaller exchange. We just talked about the differences in prices of the same product at different levels in two different. What about the case if the exchange is bigger in one place, smaller in another place? You can buy in one place, unable to sell in the other place, then you're stuck. You also have to look at the micros this way as well. The persons who are actively engaged in seeking out minor pricing discrepancies are called arbitrageurs. These probably would be just members of brokers. Because obviously when you're buying and selling, there is cost involved as well. So maybe as an investor, it would really not be a good idea for you to get into arbitrage. The amounts, the quantities are going to be big. The difference is going to be small. But calculating on the number of trades that you do, it'll cost you a lot. Maybe it might be a good idea to arbitrage as an investor, but it's always a good idea for players or market participants or the members to do the arbitrage trade, because maybe commissions are not as much for them. Arbitrageurs keep prices in the marketplace efficient. If it were not for arbitrages, you might not see such depth in the market too. So arbitrageurs keep prices in the marketplace efficient. They always have a buy and sell demand in the market because they're talking about big quantities. So an efficient market would then be one which securities are priced in accordance with other perceived levels of risk and their potential return. We talked a lot about risk and return in earlier lectures. Where there's risk, there is return, and there was a trade-off between risk and return. So arbitrageurs have the capacity to create a market. They have the capacity to buy and sell in large quantities, which probably an ordinary investor might not be able to do. It's always a good idea to have arbitrageurs in the market. Let's have a look at an arbitrage example on your screens right now. And the example then would be a stock price is quoted as 100 pound sterlings in London and $172 in New York. If you were to look at the exchange rate is 1 pound sterling is equal to 1.75 US dollars. So then you'll be able to maybe buy stocks in New York, sell them in London, and get the cash, which would probably be bigger in numbers than the US stock exchange. You'll get more per dollar, or you could use it to whatever way you can look at. Maybe you can buy at the London Stock Exchange, you could sell at the London Stock Exchange. You have to look and understand the arbitrage example to comprehend the difference between the prices in relationship to the currency exchange rate. So you could take advantage of getting more dollars while selling it at the US exchange and buying it at the London Stock Exchange, because you'll get more dollars for your pounds. You have to look out where you need to sell, where you need to buy. Is it going to be London or is it going to be New York? Work it out and have a look at what would be a good idea to use this as an arbitrage example and try to understand the differences in prices or the difference in the exchange rate. Remember, I told you you could trade in different exchanges in different countries, or you could also trade in the same country in different exchanges. In this case, you're talking about two different countries and two different foreign exchanges as well. So you've taken advantage of the exchange rate. Now, you risk, you get a return. But if you hedge risk, you've got to do it in a sensible way. While we're talking about hedging, while we're talking about hedging risk, I mentioned about the spread between the regular market and the futures market. That spread is called a basis. The basis is the difference between cash price and future price. Basis is the difference between the price in the regular market of the same product and the price in the futures market is different. So you use the basis as the way of taking advantage of buying in the regular market, selling in the futures market, or vice versa. But there is a basis risk, the risk of an unexpected change in basis prices, basis points. So hedging reduces risk if basis risk is less than variability in price of hedged assets. Risk cannot be entirely eliminated, we know that, but risk can be minimized. Risk can be managed. So you take advantage of the basis difference between a regular price and a futures price by the difference that you see in the basis points. Of course, there is the basis risk, but I think we should focus more on the basis difference. You take advantage, the guaranteed difference between basis in the regular market and the futures market. If you were to be talking about hedging with stock index futures, we'd be talking about selling futures contracts against diversified stock portfolio that allows the transfer of systematic risk. So if you've got a portfolio bought up in the regular market, you can sell in the futures market, you can selling futures contracts, selling the index to make your portfolio a much more comfortable thing to have with you. Diversification, we've talked about this a number of times. Diversification eliminates non-systematic risk, and that's why we have portfolios. Hedging against overall markets decline, and it offsets value of stock portfolios because future prices are highly correlated with changes in the value of stock portfolios. So it would be a good idea to be holding on to a portfolio and selling the stock index future, maybe. So you've secured yourself, you've just minimized risk. Remember, the future would have the index difference would there be reflected in the basis, which would be a different price than the regular market. So your portfolio then would create a bigger price in the futures market. So you would have a lesser price in the regular market, and then you are hedging against overall market decline. You're safe. Nothing is going to bother you in the portfolio once market starts coming down because you've sold the future index. It helps to hedge. Does it help to speculate? Maybe yes, maybe no. But if you're using future contracts as a speculator, you would be maybe buying or selling future contracts in an attempt to earn a return. It is an attempt, a risky attempt that would make or break your finances. This would mean that you do not have your contract covered, which would mean you do not have prior regular market or a prior spot market position. You are not holding on to something. In hedging, you hold on to something in the spot market and you sell in the futures market. But in speculation, you have no prior spot market position. You're exposed to all the uncertainties of the market. You absorb excess demand or supply generated by hedgers. Hedgers are passing on the risk to you as speculators. You have the capacity to absorb excess demand or supply generated by hedgers, assuming the risk of price fluctuations that hedgers wish to avoid. Hedgers avoid all the fluctuations. Speculators are willing to take that risk. So, speculation encouraged by leverage, ease of transaction, low cost just encourages you to speculate more. We're talking about margins as low as maybe 5 to 10%, and you can expand your positions, leverage your position by as much as maybe 10 times. And that is where the time bomb is actually lying, because you are going to be responsible to the total amount that you expose yourself in speculating. Now, if we were talking about speculating with stock index futures, then understand this by way that futures are effective for speculating on movement in the stock market. Why? Why are futures effective in speculating on the movements in the stock market? Because there is low transaction cost. There is a low transaction cost in the futures market. So, stock index futures prices reflect the regular market. And traders expecting the market to fall, buy or sell, maybe. You all have to look at whether you want to buy in the market, whether you want to sell in the market. If you're looking at the futures, you may be selling if you think there is going to be fall in the market. But if you think the market is going to rise, you buy in the market. Maybe you can buy index futures, you can sell index futures depending on the direction that you think is the right direction. The stock index futures prices mirror the market. Naturally, it has to, because the index has got to complete itself by having all the market participants. Depending on what sort of an index it is, it will reflect the market. Naturally, there's more cost involved in trading in the regular market, much lesser cost involved in trading in the futures market. One of the reasons people get excited about trading in the futures market without realizing the risk involved. Although you might just have given a 10% down margin, you are actually responsible for the rest of the 90 as well. If taking a 100% position with a 10% margin, you're actually responsible for the profits and losses of the entire 100% position. It's not just the margin that you've given and that responsible. You earn on the entire amount, you lose on the entire amount as well. So you could understand that futures contract spreads are available both in long and short positions. Both long and short positions are at the same time in different contracts. You can buy, you can sell, you can go long, you can go short in different contracts in the futures contract spreads. There is an intra-market spread as well. An intra-market spread depending on the calendar or the time. Same contract, but different maturities. You have a 30-day maturity, you have a 60-day maturity, and you have a 90-day maturity. So you can also, there's going to be separate markets, so they're going to be spread within these markets as well. Maybe a 30-day future contract costing more and a 90-day future contract costing less because of the time period. The intermarket or quality spreads as well. Same maturities, different contract. Earlier I talked about same contract, different maturities. It's all in the words, it's all in the markets, it's all in the contracts, all in the product. It's about qualities and quantities and times. You have to play your game right. But before that, you need to understand the rules of the game. If you're interested in relative price as opposed to the opposite price changes, would be one way of speculating the stock index futures. So these spreads can give you advantage looking at intra-markets, looking at intermarkets, looking at different markets in time, and looking at different products in the same time. If I was to refer to a financial future, I would maybe talk about contracts on equities, and maybe talk about contracts on indices, and maybe talk about contracts on fixed income securities, and maybe even talk about contracts on currencies. These are all financial futures, and there is an opportunity in them. An opportunity to fine-tune risk-return characteristics of a portfolio. At maturity, stock index futures settle in cash, which would mean it is difficult to manage delivery of all stocks in a particular. Now, if you're talking about indices, if you're talking about stock index futures, you've got to understand one thing. It's better to settle it in cash and not talk about deliverables. How will you be able to handle all the different products in the portfolio and in the proportion that they are in the portfolio to be delivered to you in the exact same proportion? So you normally talk about index futures in a way that you'd be settling them in cash, not going for the delivery of the product. So you cash settle the stock index futures. These are ways that you can hedge. There are ways that you can get into the financial futures products of the derivatives market. The income securities, fixed income, variable income, bonds, other things related. There's a number of products that you could use to your advantage while doing the derivatives market business in the financial futures. At maturity, treasury bond and treasury bill interest rate futures settle by delivery of debt instruments. The way you will be settling your investments is going to be in different regimes. Also, we must understand, if you expect the bond prices and the T-bill prices to increase, then maybe you will sell. Or if they're going to decrease, maybe you're going to think about buying them. We're talking about interest rate futures. We just talked about index futures. This is about interest rates. So maybe if it increases, you sell. If it decreases, you buy. You can talk about anything in the financial futures market as a way of investments. Maybe it increases, maybe it decreases. So increase or decrease in interest rates will decrease or increase spot and future prices. They're correlated. There will be increase in interest rate, there will be decrease in spot and future prices, or there will be decrease in interest rates, there will be increase in spot and future prices. It is difficult to short bonds in the spot market. We're talking about the cash market. Now, it's not a good idea to talk about bonds and shorting them in the spot market. Now, all this is about futures. So, you could be shorting bonds, but it is very difficult. Especially so because they've all got fixed incomes, fixed rates of return. You're not going to be very excited about getting the same thing back at the same price, because there's not going to be any volatility in the prices. If you were to look at index trading a little bit more as a version of program trading, we would understand that to be an exploitation of price differences, an exploitation of the price difference between the stock index futures and index of stocks underlying future contract. We will also be talking about arbitrages, build hedged portfolio that earns low risk profits equaling the difference between the value of cash and future position. This is how you take exploitation of the price differential. This is how you take the difference in different intermarkets and intramarkets and take an advantage of it. These are different ways that we can look at the derivatives market and take advantage of all this to our benefit. The discrepancies in prices, the difference between a regular market price and a futures market price, the difference or the basis spread between a future price and a spot price. You take advantage in the arbitrage by using the same product in two different exchanges, even two different currencies, or through hedging by buying an underlying asset in the spot market and selling it in the futures market, or through just speculation by taking a wild guess on the direction of the market. These are major three ways that you talk about as the way of making use of the derivatives market. You could either be a hedger, you could also be a speculator, or maybe just an arbitrager. And these are ways that we will be discussing and looking at how to use derivatives. And just when we are about to wind up this lecture, just briefly we'll talk about this in later, that we can use derivatives as in managing risk, also for income generation, and for financial engineering as well. But that's for later. Right now, we've talked enough about the subject of derivatives. Just revise all that we've studied, and then we'll go on and talk a little bit more of derivatives in the next lecture. Thank you very much.